Good morning. The Oversight and Investigation Subcommittee will come to order. The title of today's subcommittee hearing is the Dodd-Frank Act and Regulatory Overreach. Without objection, the Chair is authorized to declare a recess of the subcommittee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous material to the Chair for inclusion in the record. Without objection, members of the full committee who are not members of this subcommittee may participate in today's hearing for the purpose of making an opening statement and asking questions of the witnesses. The Chair now recognizes himself for 3 minutes for an opening statement. Good morning, and thank you for being here. This morning's hearing will critically examine a major assumption underlying the Dodd-Frank Act, that the primary cause of the financial meltdown was misbehavior by market participants, exacerbated by lax regulatory oversight. This hearing will also explore the inadvisability and/or inefficiency of overhauling financial regulations, as was done in the Dodd-Frank Act, in the immediate aftermath of a financial crisis. The Obama recovery has been the slowest recovery in modern times. And the question is, why? Well, it's simple. This administration is more focused on growing government than growing the economy. Those who supported Dodd-Frank have been more concerned with helping special interests in Washington than their constituents back home, and the proof is in the numbers. They don't lie. Fewer people have returned to the workforce than any other modern recovery. Banks are closing every week, and the #1 cause that I hear from people back in Wisconsin is the excessive, crushing regulatory burden imposed by this administration. And Dodd-Frank is a major cause of that burden. The crushing regulatory regime created by Dodd-Frank continues to keep people out of work, to keep businesses from hiring, and makes it harder for my constituents to get the loans they need to finance the expansion of their business or to buy their first home. Dodd-Frank makes it worse. It doesn't end too big to fail. And as Jamie Dimon put it, quote, Dodd-Frank is the moat that keeps new banks from entering the market. It stifles innovation, access to capital, and economic growth, end quote. A 2014 survey by the American Bankers Association found that 80% of respondents expected Dodd-Frank regulations to measurably reduce their credit availability. The people hurt by this oppressive regulatory regime are the poorest among us. She is the student who graduates with a mountain of debt and no job prospects. She is the mother working 2 part-time jobs and still struggling to make ends meet. Dodd-Frank costs the average American $334 a year in lost wages. Unfortunately, she can't see the cause of the distress, which was written right here in this building by the very people who sit on this panel. And they refuse to make changes to that law that are hurting the poorest among us who are struggling to make ends meet. I hope we have a thoughtful conversation today about what kind of reform can be offered to make Dodd-Frank work better, make our markets work better and our banks work better to serve growing businesses and American families. With that, I yield 2 minutes to the ranking member, Ms. Waters from California. And that's 2 minutes.
Thank you very much. Before I begin, I'd like to remind my Republican colleagues that after today, there will be just 23 legislative days left until the Export-Import Bank closes its doors, and this committee has yet to hold a hearing on reauthorization. I think it's important that we remind everybody that we're approaching that date. When the market crashed in 1929, it sent shockwaves through the world economy. Stock prices plummeted. About a third of all U.S. banks failed. A quarter of Americans were out of work. Shanty towns filled with desperate roving workers sprung up, often next to soup kitchens. Knowing that something had to be done to restore confidence, the Congress and President Roosevelt ushered in bold and smart financial reform. We created the SEC. We helped reassure depositors with FDIC insurance, and we separated speculative activity from retail banking. In the post-war period that followed, things weren't always great, especially for African Americans and others who were unconstitutionally denied access to the fruits of American productivity. But we didn't experience any more devastating financial crisis. In the 1980s, the deregulation of our financial system started to gain steam. Congress deregulated thrifts. Banking regulators slowly allowed retail banks to encroach into more investment banking. And Congress sealed the deal by passing legislation, tearing down that wall completely, legislation I voted against. Eventually, these many small actions, combined with regulators' failure to act, culminated in the largest financial crisis since the 1929 crash. I won't be able to finish my statement here today, but of course, Dodd-Frank was all about reform. It was about protecting consumers, and so we created the Consumer Financial Protection Bureau. We dealt with making derivatives more transparent, on and on and on. And this is what we have people railing against, the fact that we created reform in the financial system. I yield back the balance of my time.
The gentlelady yields back. The chair now recognizes the gentleman from Virginia, Mr. Hurt, for 2 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I want to thank you for holding today's hearing. Pleased that this subcommittee is taking the time to analyze regulatory overreach in the Dodd-Frank Act. I'm also pleased that this committee has extended an invitation to a constituent of mine, Paul Mahoney, Dean of the University of Virginia School of Law, to testify before us today on this critical issue, and I'm pleased to have the privilege to introduce him. I'm certain that his expertise in the field of securities regulation will provide insight into the financial crisis of 2008 and the ongoing effects of the regulatory response implemented with Dodd-Frank. Mr. Mahoney received his bachelor's degree in electrical engineering from Massachusetts Institute of Technology in 1981 and his law degree from Yale in 1984. Before his career in academia, Mr. Mahoney worked in private practice and clerked for the United States Supreme Court. He's been published in several law reviews as well as finance and economics journals, and recently had his book Wasting a Crisis: Why Securities Regulation Fails, published this year by the University of Chicago Press. He joined the University of Virginia Law School faculty in 1990 and became its dean in July 2008. I hope that today's hearing bears testimony that provides guidance on potentially harmful regulatory overreach and ideas on how to best promote safe and efficient financial markets. I look forward to Mr. Mahoney's testimony and the testimony of our other two distinguished witnesses today. Thank them for their appearance. Mr. Chairman, I thank you for the time, and I yield back the balance.
The gentleman yields back. The chair now recognizes the ranking member, gentleman from Texas, Mr. Green, for 3 minutes.
Thank you, Mr. Chairman. The style of the hearing is the Dodd-Frank Act and regulatory overreach, which begs the question, because indicated in the style is the conclusion. So the hearing is really not about acquiring empirical evidence. It's really about substantiating a position that has already been assumed. How soon we forget is probably a more appropriate style for this hearing. How soon we forget, because there are some lessons that we should have learned from the 2008 Great Recession Depression that we seem to be forgetting. How soon we forget. Let's talk for just a moment about some of the lessons that we should have learned. One, capital markets don't regulate themselves. The Great Depression recession would not have occurred if capital markets regulate themselves. If we had had self-regulation, we wouldn't have had 327s, 228s, liar's loans, no doc loans. If they regulated themselves, we wouldn't have had teaser rates that coincide with prepayment penalties. Capital markets don't regulate themselves. Two, too big to fail is the right size for constant observation to spot potential crises. That's why we have FSOC, so that we can watch, so that we can do what we did not do that allowed the 2008 Great Recession Depression to occur without our catching it and preventing it. Two, prudential regulation to protect the consumer and the economy is necessary. You have to have prudential regulation, because if you don't, you'll end up with another Great Recession Depression. This is why we have the CFPB. This is why we have FSOC. We have to find ways to not only catch, but also to regulate. And number three, judicious elimination to prevent economic chaos is important. We've got to make sure that we are constantly looking for a means by which we can prevent this economic chaos that occurred before. And finally, I would say this, that success of legislation does not prevent the elimination of legislation. Because if it did, we wouldn't be about the business of trying to eliminate the Ex-Im Bank. The Ex-Im Bank is a great American success story. Jobs have been created, money sent to the Treasury, a great American success story. Yet we are on the eve of the elimination of the Ex-Im Bank. So there are some lessons learned that we ought not repeat. My hope is that the style of the hearing will not allow us to focus solely on what we already believe to be the case. Rather, let us look for empirical evidence so that we can have logical, reasoned arguments about the status of Dodd-Frank. I yield back.
The gentleman yields back. Thank you, Mr. Ranking Member. Mr. Mahoney, I would offer you a great introduction, but you've already had one from your member of Congress, Mr. Hurt. But just to reiterate, Mr. Mahoney is the Dean of the University of Virginia Law School, a very long and accomplished record. Thank you for being here today. Ms. Pierce, Ms. Hester Pierce is the Director of Financial Markets Working Group and Senior Research Fellow of the Mercatus Center at George Mason University. Before joining Mercatus, Ms. Pierce served on Senator Richard Shelby's staff on the Senate Committee on Banking, Housing, and Urban Affairs. In that position, she worked on financial regulatory reform following the financial crisis of '08, as well as oversight of the regulatory implementation of the Dodd-Frank Act. Ms. Pierce served at the Securities and Exchange Commission as a staff attorney and a counsel to Commissioner Atkins. Before that, she clerked for Judge Roger Andwelt on the Court of Federal Claims and was an associate at a Washington, D.C. law firm. She earned her B.A. in economics from Case Western Reserve University and her J.D. from Yale Law School. Thank you for being here, Ms. Pierce. Mr. Stanley is the Policy Director of Americans for Financial Reforms. Dr. Stanley has a Ph.D. in public policy from Harvard University and previously worked as an economics and policy advisor to Senator Barbara Boxer as a senior economist at the U.S. Joint Economic Committee and as an assistant professor of economics at Case Western Reserve University. Thank you, too, for being here. The witnesses will now be recognized for 5 minutes to give an oral presentation of their testimony. Without objection, the witnesses' written testimony will be made part of the record following their oral remarks. Once the witnesses have finished presenting their testimony, each member of the subcommittee will have 5 minutes within which to ask the witnesses questions. On your table, there are 3 lights. Green means go, yellow means you are running out of time, and red means stop. The microphones are very sensitive, so please make sure you are speaking directly into it. And with that, Dean Mahoney, you are recognized for 5 minutes.
Chairman Duffy, Ranking Member Green, and members of the committee, I appreciate the opportunity to speak with you about regulation and financial crises. Effective and cost-efficient regulation is essential to the health of financial markets. Unfortunately, the way in which major financial reforms are created almost guarantees ineffective and inefficient regulation that curtails competition and thereby harms investors. Major reforms always follow a stock market crash. Elected officials and regulators, hoping to avoid blame for the crash, claim that misbehavior by market participants created the problem and that more regulation will solve it. They ignore the unintended consequences of prior regulations and policies. The Dodd-Frank Act fits this description. Bad policy likely contributed to the subprime crisis. From 2002 to 2006, the federal funds rate was lower than recommended by the Taylor Rule. Federal housing policies encouraged mortgage lending to homeowners with poor credit. And the government's history of stepping in to protect certain creditors of insolvent financial institutions from loss to avoid systemic risks, a phenomenon called too big to fail, created moral hazard. Dodd-Frank's proponents, however, argued that the crisis was a consequence of too little regulation. They did so by selectively focusing on over-the-counter derivatives, which were less regulated than exchange-traded derivatives, and on the so-called shadow banking system consisting of non-bank financial intermediaries. But the crisis, in my opinion, was largely the consequence of large and highly leveraged investments in mortgage-related assets by heavily regulated commercial and investment banks. Many commentators have noted that the implicit government guarantee of the too-big-to-fail banks created moral hazard. But the way in which that guarantee interacted with securitization and derivatives has not gotten the attention it deserves. Financial innovation reduces the cost of transferring risk from one party to another. In a normally functioning system, this would disperse risks. But our system was not functioning normally. The implicit government guarantee enabled large banks to take on risks that their creditors would otherwise not have stood for. After all, the creditors believed they would be protected in the event the bank became insolvent. Thus, risks in the form of mortgage-related assets became concentrated in the too-big-to-fail banks in the run-up to the subprime crisis. Dodd-Frank's proponents therefore have the causation wrong. Financial innovation was not the primary cause of the buildup of risk. The implicit guarantee was the primary cause. The use of securitizations and derivatives to concentrate risk was not mindless gambling facilitated by lax regulation, but a purposive and rational attempt to maximize the private benefits of the implicit government guarantee. Choosing to see the origins of the financial crisis in insufficient regulation rather than in the unintended consequences of prior government policies has important practical consequences. Dodd-Frank subjects non-deposit-taking institutions to regulation by the Federal Reserve, which in practice may mean that they will be regulated like banks or bank holding companies. If so, a likely consequence is that there will be fewer and larger financial intermediaries in the United States. Some insurance companies, private equity funds, and institutional asset managers operate under the umbrella of a bank holding company, but most do not. If the standalone entities are regulated as if they were banks, a possible result is that bank holding companies will begin acquiring them to economize on regulatory costs. This would be good news for the largest U.S. banks and for the regulatory agencies that oversee them, both of which would become larger and more powerful. But there's no reason to think it would be better for investors, depositors, and taxpayers. And it is exactly the opposite of the model that many Dodd-Frank proponents say they favor, which is a model of smaller, more focused banks. Time and again, regulated industries and their regulators have used a financial crisis to pursue their private goals, which are not congruent with the public interest and often result in decreased competition and innovation. My recently published book describes how this occurred in the aftermath of numerous past financial crises. To avoid this phenomenon, financial reform should be made incrementally and preferably during non-crisis periods. For example, careful observers of the financial markets warned about excessive leverage for many years before the subprime crisis. It would have been useful to focus regulatory attention on capital requirements for commercial banks and their holding companies, and to impose appropriate capital requirements on investment banks and other financial intermediaries. Instead, Congress waited until after the crisis and designed a statute that increases the reach of bank regulators and will likely increase the market share, size, and political clout of the too-big-to-fail banks.
Mr. Mahoney, thank you for your testimony. Ms. Pierce, you are now recognized for 5 minutes.
Chairman Duffy, Ranking Member Green, and members of the subcommittee, thank you for the opportunity to be here today. The crisis was a welcome wake-up call that what happens in the financial sector affects the rest of the economy. The crisis was built on flawed regulation, and the response to the crisis is built on a flawed narrative that that market failure was to blame. And so the flawed narrative led to a solution that was built on additional flawed regulation. The consequences are serious. Not only is a future crisis likely, but in the interim, our economy is not living up to its full potential. A well-regulated financial system is the key to a strong economy. It directs funds to individuals and businesses that can best use them, and it disciplines those that fail. Poor government regulation can distort the financial system's ability and inclination to respond to the signals that it gets from consumers, Main Street companies, and investors. We saw the results of that kind of distortion with the crisis in 2007 to 2009. And when the bubble burst, many people suffered tremendously as they lost their homes, jobs, and retirement savings. But even before the dramatic failures of 2008, think of all the sectors that didn't get funds because funds went into the housing market because of regulatory inducements. As the last financial crisis unfolded, there was understandable outrage. We needed to do something fast, and the result of that was Dodd-Frank. Dodd-Frank was developed on the false narrative that the crisis was the product of inadequate regulation. If only we had regulated the financial system more tightly, the story goes, we wouldn't have had the crisis. But the role of the regulatory system in provoking and deepening the crisis was ignored in the post-crisis frenzy to set things right. The regulations played an important role in the crisis, as Dean Mahoney just outlined, there are multiple government policies, from government housing finance policy to the regulation of credit rating agencies to bank regulation, that helped to encourage markets to look to regulatory signals instead of to market signals to dictate their behavior. The result of the false narrative, as one might expect, was a statute that doubles down on regulation. A blanket of new regulatory agencies and new regulations was thrown around the financial system, from the CFPB to the Volcker Rule to a whole new regime for credit rating agencies to the Financial Stability Oversight Council. The post-Dodd-Frank regulatory system makes regulators even more important movers and shakers in the financial system than they were before the crisis. They are determining how financial firms are structured, what activities they are engaged in, and how they are funded. They're even trying to attend bank board meetings. Strategic decisions are being made by regulators, not by firms, their managers, and their shareholders. Our financial sector is turning into a set of public utilities with the characteristic high prices, poor service, lack of creativity, and lack of entry. Government regulators are removed from day-to-day reality. No matter how much data they collect, they cannot receive the important signals that the marketplace offers. These regulators have good intentions, but so did the pre-crisis regulators. So what can we do to make the regulatory system provide clear, strong rules without inhibiting the market's unique ability to reward success and punish failure? First, we should ensure that regulators are looking back to see what worked and what didn't in the past. It's often easier just to slap on a new rule rather than to look at whether the ones in place are working. Second, when regulators adopt new rules, they should understand what problem they're trying to solve. It's not enough just to make the assertion that this rule will prevent another crisis. And third, we should rethink the approach taken by Dodd-Frank. The desire to place key decisions in the hands of regulators is a natural reaction to a narrative that markets failed. But the new system depends so heavily on regulators to get things right that if they don't, things could go terribly wrong. As it is played out, for example, the systemic designation approach is designed mostly to give the Fed more regulatory power than to address systemic risk, which was its purpose. If we really wanted to address systemic risk, there would be clear guidance for firms to get out of the systemic risk designation. Another example is derivatives clearinghouses. We assume that pushing lots of derivatives into highly regulated clearinghouses would be an easy way to de-risk the derivatives markets. But more and more people are recognizing that these clearinghouses themselves might be the source of future troubles or even of a future crisis. Dodd-Frank was built on a false narrative about the crisis. It failed to deal with key issues in the last crisis. It covered many unrelated topics, and it created a new set of problems. If we're willing to rethink it, we'll be rewarded with a strong, dynamic economy.
Thank you, Ms. Pierce. Mr. Stanley, you're recognized for 5 minutes.
Thank you for the opportunity to testify before you today. I would like to make several broad points in my testimony. First, the Dodd-Frank reform should create very large benefits. The 2007 to 2009 financial crisis led to over $10 trillion in lost economic output and 8 million lost jobs. My written testimony includes a report that is based on a comprehensive regulatory review of all existing studies of the costs of financial crises. Based on this study, we conclude that financial regulations which reduce the probability of a systemic crisis by 50% would produce $2.9 trillion in economic benefits over the next decade. Reducing the probability of crisis by just 25% would produce almost $1.5 trillion in benefits. These figures include only financial stability benefits and do not even count the benefits of improved fairness for consumers and investors due to Dodd-Frank reforms. We believe that the Dodd-Frank Act will succeed in reaching these goals and that the benefits will far exceed its costs. Second, the 2008 crisis revealed comprehensive issues in our financial system that demanded a comprehensive solution. This financial crisis was the first crisis of the post-Glass-Steagall era. It revealed that the fusion of commercial banking and capital market activities created major new issues in the oversight of financial risk. These included the creation of an originate-to-distribute model that concealed poor underwriting, abusive lending, and securities fraud, the growth of large universal megabanks that combined commercial and investment banking and had become both too big to fail and too big to manage, and a failure by both regulators and bank management to track, understand, and control financial risk. Due to the post-Glass-Steagall interpenetration of lending, securities, and derivatives markets, the crisis also featured a prominent role for non-bank entities. The American political system, with its many veto points, creates strong reasons for legislators to pursue comprehensive change through the vehicle of a single bill. Third, while the Dodd-Frank Act is lengthy and comprehensive, it is the product of compromise and pursues incremental improvements in our regulatory system. Mr. Mahoney has stated his belief that it is wiser to engage in incremental rather than radical improvements. Examining the actual regulatory tools used in Dodd-Frank, tools such as increased capital requirements, stress testing, the use of central clearinghouses to manage risk, greater regulatory reporting and transparency, and better enforcement of consumer protections, shows that they are traditional elements of financial regulation that have been used for many decades, if not centuries. These tools have been tested over many years and are hardly radical departures. In fact, if one looks at the three major financial crises of the last century, the 1907 crisis, the 1929 crisis, and the 2007 crisis, Dodd-Frank is probably the most moderate and incremental response to a crisis out of those three. Furthermore, Dodd-Frank grants very extensive discretion to regulators to adjust the use of these regulatory tools as they are applied to different segments of the market. Finally, we believe that rolling back Dodd-Frank would be a serious error. We have supported changes in the Dodd-Frank Act where we believe such changes are called for. We have particularly supported changes to address one of the areas Mr. Mahoney highlights in his testimony, ending too big to fail and the associated practice of government bailouts. While we believe that elements of Dodd-Frank, such as graduated capital standards and Title I resolution planning, if forcefully implemented, can themselves address too big to fail effectively, we have also supported additional changes. For example, AFR has joined Representatives Hensarling and Garrett in criticizing the Federal Reserve's implementation of new restrictions on emergency lending, and we have supported Senators Warren and Vitter in their call for Congress to act if the Federal Reserve does not place stronger conditions on these loans. However, changes that roll back Dodd-Frank rules or create major new exemptions to them would in most cases have a negative impact on financial stability or consumer protection. Dodd-Frank also grants regulators extensive discretion to accommodate reasonable concerns without statutory change, and they have shown great willingness to use this discretion. In practice, the great majority of the statutory changes we have seen proposed to the Dodd-Frank Act would not build constructively on the advances made by the legislation, but would instead roll back the clock by stopping regulators from responding to the issues revealed in the financial crisis, as well as new emerging issues in the financial markets. We believe that interfering in the regulatory process in this way would be a grave error and would restore the failed status quo that gave us the 2007 to 2009 crisis. In conclusion, I'd also like to point out, just in response to some of the things that Ms. Pierce said, that significant parts of the Dodd-Frank Act are in fact instructions to regulators to do their jobs better and to do a better job handling issues like leverage that they've traditionally been entrusted with. Most of Title I does this, essentially. Thank you for the opportunity to testify. I am happy to answer further questions.
Thank you, Mr. Stanley. The chair now recognizes himself for 5 minutes. Mr. Stanley, I would have to disagree in that a 23-page Dodd-Frank bill, to call that moderate reform, I would have to disagree. I think that's pretty extensive, even when all the rules have not been now written. At the time that Dodd-Frank was written, we weren't in the middle of a financial crisis. The crisis had passed. We had time as a Congress to sit back and reflect on what the root causes of the crisis were and to try to address the root causes. Instead of reflecting and waiting and thinking, there was a rush to judgment in this institution to pass a massive bill, which I would argue a lot of folks in this town opened up their drawers, dusted off 30 years of old folders of bills that they wanted passed, that they knew they could get into a package that was going to move through the Senate and the House, which gave us the Dodd-Frank bill, which has, I would argue, wreaked havoc on our financial sector. I guess to you, Mr. Mahoney, I get concerned when I hear my friends across the aisle talk about how we've ended too big to fail. Do you think that the Dodd-Frank Act has ended too big to fail?
I don't, unfortunately. I think that by putting, and this is a point that Ms. Pierce made in her written statement, Dodd-Frank really puts bank regulators in the driver's seat in a lot of decisions that the largest financial institutions will make. It's going to be very hard for the government the next time to step back and say, this wasn't our doing, this wasn't our problem, when the regulators are driving so much of what's going to happen in the market. It is also, I think, important to note that by, in effect, pre-identifying the too-big-to-fail institutions in the guise of declaring them systemically important, the government is going to encourage the markets to think of them in the way the markets thought of Fannie Mae and Freddie Mac before the crisis. That is to say, as institutions that are government guaranteed in all but name. And it's going to be extremely difficult for the government, again, to say, not our problem when a crisis comes.
So with this new package, if it's not the fault of the markets, arguably the markets could come and say, listen, this is the fault of the regulators. They didn't get it right. Is it fair to say that those institutions that may fail will come to the regulators and say, well, it's your fault. We want a bailout?
Absolutely. Yes, I agree.
Okay. In regard to the financial crisis, was it your testimony that two portions of the root cause were from housing and monetary policy? Was that your testimony?
I think both certainly contributed.
And what did Dodd-Frank do to address Dodd-Frank and monetary policy?
Dodd-Frank really does not address monetary policy.
I would agree with that. When we have more rules and regulations in the financial sector, does it help small startups into the marketplace, or does it help keep larger institutions at the top? More rules, more regulation, help small businesses or help large businesses?
Well, my research, and I've looked at a lot of regulations, primarily in securities markets, but I don't think the insight is limited to securities markets. If you look at the actual effects, often what happens is that the regulated industry, particularly after a crisis, is able to, in effect, cut a deal. They come to hearings like this one, hang their heads in shame, and are pilloried. Meanwhile, their lawyers and lobbyists are working with the people who are writing the new regulations, whether it be Congress or regulators, and they write them in ways that entrench the position of leading firms and make it very much harder for new firms to enter the market, often drive out smaller firms from the market. This is very clear, I think, in the case of the New Deal financial reforms. They were great for the leading investment banks. They were great for the leading stock exchanges. They were great for the leading mutual fund complexes. They drove smaller regional stock exchanges out. They drove smaller broker-dealers out.
Wonderful. Thank you. And I don't have time to fully get your answer, but Mr. Stanley, you talked about the cost of the financial crisis, and I share your concern in that cost. Maybe we can follow up later to see if you have calculated the cost of overregulation, putting the clamps down on our financial sector and what that does to growth and opportunity in the country, and also what does it do if we send our capital markets from America to other parts of the world? What does that do for the security of the country, if you've calculated that as well? But I am out of time, and so with that I yield 5 minutes to Mr. Kleber.
Thank you, Mr. Chairman. Ms. Pierce, I'm curious, and this is a serious question. What do you think we should have done in this committee when the Secretary of Treasury comes in, the head of the SEC, FDIC, and explain where we're headed, if nothing is done.
I agree with you that that was a terrible time, and it was a terrifying time. And having them come in and say we need to do something was a big weight towards pushing Congress to do something. But they did not have a clear plan on what to do, and things were bad even though there was a rescue put in place. Things would have been bad if there hadn't been a rescue put in place. But I argue that not having the government not step in at that time would have made for a shorter crisis and a healthier recovery.
So because we took action, we lengthened the recession.
Yes.
So now I'm really a little confused. So what did we do to the housing market? I mean, the housing market actually collapsed, and I think you and Mr. Mahoney both were saying that we misread the state of affairs, and we actually responded to a narrative that was incorrect. Did I understand you correctly? Okay, so there was nothing going on in the housing market.
I'm sorry if I was unclear on that. What I meant to say was that the problems in the housing market were driven by regulations, and not only housing policy that encouraged people to lend to people who couldn't afford the size houses they were buying, but it also...
Excuse me. Do that one more time. I don't want to misunderstand you.
So there are different elements of government policy that led to the housing crisis.
Okay.
One was that we encouraged loose underwriting standards, but a second important one, there were... I should actually have put the other one first, because the first thing is bank regulations that encouraged banks to hold certain types of securities, in this case, mortgage-backed securities, which drove a demand for mortgages, which then drove to the writing of a lot of subprime mortgages.
But the large banks were heavily invested. They were heavily invested into mortgages.
They were. And
so when the housing crisis hit, I mean, you do agree that we had a housing crisis?
I agree with that.
Okay, so so that impacted the balance sheets of the banks. Am I correct?
It did, right.
And so you're saying that with that going on, the responsibility for this committee was to do nothing?
If you're asking me whether TARP was a good idea, I don't think that TARP was a good idea. It was a bailout that perpetuated this notion that the government would step in when there's a problem.
I'm sorry, go ahead.
It perpetuated the idea that people who make bad decisions are not responsible for the consequences. And I'm talking about the banks who made bad decisions. They should have been responsible for the consequences of their decisions.
Yeah, I agree with you. I agree with you on that. But I'm not sure that I understood the answer. Either you or Mr. Mahoney. Where I'm getting at is, so the response we had was to walk into the committee room where we met and say, we're in the midst of the greatest financial crisis since the Great Depression, and let us together hold hands and do nothing.
Restraint is sometimes the best indicator of wisdom.
So you're saying that's what we should have done?
I'm not saying that the crisis wouldn't have been bad, but the crisis was bad even with the emergency programs that were put in place. There are certain things that could have been done to help homeowners, for example, to soften the blow, but to take this big action of putting money into banks was not a wise response. And I understand what drove it, but I would argue that it perpetuated the problems that we have.
Thank you.
The gentleman yields back. The chair now recognizes the gentleman from Virginia, Mr. Hurt, for 5 minutes.
Thank you, Mr. Chairman. Mr. Mahoney, Dean Mahoney, I was intrigued by your testimony and what you have to say as you sit before a committee of federal policymakers that your studies have shown that, or your study has shown over the course of history that so often the effect or the underlying problems that we have had in terms of stock market crashes, that so often Federal policy makers respond in a big, bold way in order to, frankly, cover themselves politically. And I think that that's interesting when you consider the Dodd-Frank and why it was passed in the way that it was and what the consequences have been. And I guess what I would ask you to comment on is sort of the irony that Federal housing policy was, in my mind, and I think in the minds of many well-respected people, very much the cause of what happened in 2008, and what an irony it is that here we are, 7 years later, and we still haven't put a glove on Federal housing policy and Fannie Mae and Freddie Mac, and Dodd-Frank doesn't do anything about that. And I was wondering if you could comment on that that irony, and why is that? Is that consistent with what you have found as it relates to policy responses to previous crises?
Yes, thank you. And I think that there are two underlying problems, and I think they are surfacing in some of the discussion we're having here. First is the notion that it's just about the quantity of regulation. It's just, should we have more or less? And that's a very easy way for policymakers to avoid responsibility and just say, well, we layered on more stuff, and so we've done what we're supposed to do. The second big problem is to see regulation as, in some sense, a punishment of the financial industry for what it did in the past, as opposed to looking forward at how do we prevent problems in the future. And that makes it very easy for the regulated industry, again, to come in, hang its head in shame, but in the meantime work on shaping the regulations in ways that benefit them. If you want to punish banks and too big to fail, don't layer on more authority for bank regulators.
Thank you. I come from a district, a rural district in Virginia. I think that if you look at the trends over the last 30 years, you see that community banks have taken have seen real losses. I think we've gone from somewhere around 15,000 community banks to today to about 6,000, and a lot of that decline has happened in the last 6 years since Dodd-Frank was enacted. And I guess enacted with the idea that it was going to end too big to fail, I would suggest that it has only enshrined it. And I was wondering, Mr. Stanley, if you could, when you hear community banks talk about the tremendous and profound challenges that they face in implementing implementing Dodd-Frank, do you think they're lying, or do you think that they are being sincere?
I think that there has been a long-term trend toward a decline in the number of community banks that dates back to the 1980s that is driven by many different factors.
But what about specifically the effect of Dodd-Frank?
I think it's too early to conclude as to whether Dodd-Frank has actually changed that trend line. I do think that.
Do you think that having fewer community banks contributes to a healthy economy, where there is more competition, where you have more innovation, and consumers have more choice and lower costs?
No, we are supportive of the community banking model and of the relationship lending that is included in the community banking model. We believe in assisting community banks to comply with regulations. It can be more burdensome on smaller entities to comply with regulation. We understand that. We do also feel, however, that competition with large banks and changes in economies of scale have contributed to the decline in the number of community banks, and we feel that Dodd-Frank makes many accommodations to community banks. Regulators have been willing to exempt community banks in many cases, and Dodd-Frank does specifically call for regulators to be tougher on larger banks than smaller banks, and we support that.
Thank you, Mr. Stanley. My time has expired.
The gentleman yields back. The chair now recognizes the gentleman from Minnesota, Mr. Ellison, for 5 minutes.
Chairman and Ranking Member, appreciate the time. And I'd also like to thank you, Dr. Stanley, because I think that, you know, the incredibly important feedback Americans for Financial Reform provides this committee is helpful.
Thank you.
I also want to say publicly that your colleagues and your partners have been reliable and responsive to legislation, hearings, topics that would help and weaken consumer protection and investor protections. And I'm glad to be able to benefit from the work that you all do by knowing a little bit more and being a little more informed. And the Americans for Financial Reform budget is tiny, particularly compared to other players in this space. But you all still, you know, show up every day and try to look out for the consumer. And I just wanted to say publicly that I appreciate it.
Thank you.
So I wonder if you would offer your views on a New York Times editorial from yesterday entitled "The Title Insurance Scam." I don't know if you saw this article. It's actually not really fair for me to spring it on you, but I know you review the literature, and so I wonder, did you have a chance to see this particular article?
I did see it, yes.
I wonder if you wouldn't mind just offering your candid views on how title insurance is routinely handled.
Well, I think that editorial was citing new evidence from New York that frankly adds to a mountain of evidence that title insurance, particularly affiliated title insurance, is a broken market. That it's marked by kickbacks between the lender and the title insurer. That consumers don't and often aren't able to shop around for less expensive title insurance, so they are exploited through title insurance that's massively overpriced and that charges excessive fees. And I think that this really underlines the importance of controls on title insurance and not making exemptions for title insurance in the legislation, in the consumer protections that we have.
Well, thank you. I mean, before Dodd-Frank, and I know we're talking about Dodd-Frank around here quite a bit, you know, what we saw quite a bit is predatory lending. We saw securitization. We saw a lot of problems in the consumer market. And I just hope that some of our critique of Dodd-Frank keeps in mind what Dodd-Frank was passed to try to fix. You know, we now have a Consumer Financial Protection Bureau taking steps to lower costs, provide access to high-quality mortgages, and ensure that home buyers get early notice of their actual closing costs. And yet I'm sure you're aware, and many people in this room are aware, that Congress voted to weaken those protections recently, and most recently to enable steering to affiliated title insurance firms to higher cost manufactured home loans. And so that's a concern of mine. Let me ask you this, Dr. Stanley. Are you concerned that if we do not try to step into the affiliated title space, that consumers could be and home buyers could be hurt?
Yeah, as I said, you know, the New York Times editorial highlighted evidence of precisely that kind of harm that came out of New York State. There's been the GAO has highlighted some of the same issues at a national level. I think the cap on points and fees that was associated with the qualified mortgage rule would have done a great deal and should do a great deal to protect consumers from this kind of exploitation. But if we put in exemptions for some of the most problematic areas, such as title insurance, it's going to lose its effectiveness.
I only got a little while, so I just want to ask you a question. I have a bill out there called the Insure Fair Prices in Title Insurance Act. It's H.R. 1799. Have you had a chance to review it?
I regret to say I've not had the chance to review that bill, but some of my colleagues in AFR may have.
Okay. Well, no problem. I'm not going to ask you to offer an opinion on. And by the way, I wouldn't be sensitive if you didn't like it, but if you knew anything about it, I thought I'd ask. And with my last moments, Can you offer your views on some of the investor protections put in place by Dodd-Frank?
Yeah, well, I think the registration of private equity and hedge funds, which creates a fiduciary duty, we saw when the SEC did a follow-up investigation based on that, they found violations at up to 50% of private equity funds. I think there are other protections in the securities markets in terms of asset-backed securities and the underlying data there that are valuable, although I think they could be better implemented.
I think that little click noise means that I'm way out of time. So I do want to thank you again and thank the Chair.
The gentleman yields back. The Chair now recognizes Mr. Fincher from Tennessee for 5 minutes.
Thank you, Mr. Chairman. Appreciate you having this important hearing addressing the concerns we all have about Dodd-Frank and what's the impacts it's having on our districts in the country. I was just making a few notes listening to the testimony of the witnesses and listening to the conversations from the other members. How many problems that Dodd-Frank has actually solved since it's been passed. And when I go back home to my districts every week and talk to my local community bankers who are telling me that, you know, Stephen, Washington just doesn't get it because the people at the top are not being harmed as much as the folks at the bottom. They're the ones that can't get loans anymore because Dodd-Frank has made it impossible for the banks to be able to loan these guys money. Crushing banks through unnecessary regulation crushes the consumer. This is not about making community banks pay for something they had nothing to do with back a few years ago. And to reiterate something that Mr. Hurt said a few minutes ago, government was had a big hand in what happened with telling banks who to loan money to and who not to loan money to loan money to people that couldn't pay it back. They had a heavy hand in how all of this started and how all of this unfolded. And it's almost to the, I don't want to read too much into it, but some of the comments that the opponents or the proponents of Dodd-Frank make, it's almost like they want to do away with the community banking industry and all of the competition and just have one or two big banks run everything. And, you know, back home in our district, something that's the overall theme is, you know, big government is good for big business, but it does nothing to help the small guy. It crushes the small guy. And then you look at Dodd-Frank and how it's being carried out. Congress doesn't appropriate money. It gets its money from the Fed. We have very little when it comes to holding them accountable for what they're doing. They make the rules. They write the rules themselves. They regulate how they see fit with almost no oversight. Director Cordray, not a panel of people that actually make the decisions on what's happening and who's it affecting, but one guy. So, you know, what is wrong with trying to fix all of these unnecessary burdensome regulations that are hurting our constituents on both sides of the aisle? You know, we have a bill, a manufactured housing bill, something that was unintended in Dodd-Frank, that Mr. Frank, former member Barney Frank, former chairman Barney Frank addressed that it needed to be taken care of. Ranking Member Waters also just a few months ago signaled that we needed to fix this problem. But now it's become a very partisan issue. We can't touch it because it's part of Dodd-Frank. This is the problem. This is the problem. We need to do what we can to make sure we're working for our constituents, not more government and more burdensome regulation. Question, Mr. Maloney, would it be beneficial, and I know the answer, but I want to hear your feedback, if we allowed these rules and these regs to sunset a lot of it? So we could go back. We had a jobs bill last Congress, and it was dealing with the IPO process and Sarbanes-Oxley, and if some of that would have been allowed to sunset, we would not have had to do what we did to fix that problem. So comment, please.
I agree with that, and I recognize the pressure that any policymaker feels in a time of crisis to do something. I agree with Ms. Pierce that it's often the right thing not to give in to that pressure, but I understand the pressure. One way of reducing the cost would be to have automatic sunset provisions in legislation so that once things have cooled down, that we can go back and say, what is it that actually needs to be done here? And I just want to make the observation that one of the things that Dodd-Frank clearly does is it increases the authority of the bank regulators over non-bank entities. Well, if you say, well, okay, so let's go back to roughly, say, 2006. What did the Fed know at the time? It could see that the default rate on subprime loans was rising. It could see that housing prices were beginning to fall in many areas of the country. Why didn't it do something at that point? Was it because there was no statute that said think about systemic risk? Or was it that the Fed, just like the banks that it regulates, figured the ultimate experience with losses here is going to look like it's always looked, and that's not going to be.
My time's expired, but the answer is more government is not the answer. I yield back.
Thank you. The gentleman's time has expired. The Chair now recognizes Ms. Beatty, Congresswoman from Ohio, for 5 minutes.
Thank you, Mr. Chairman. Thank you, ranking members. And thank you to our witnesses for coming in today. In reviewing the testimonies and in my short time here listening to both sides of the aisles, it's very interesting to me. One document, the Dodd-Frank, with so many different interpretations and opinions and purposes. But one common thread that I've listened to from my colleagues on both sides of the aisle, going back to our districts, how do we explain this? Consumers has been mentioned by everyone. So, in problems. So, for me, I put in achievements of Dodd-Frank. So, I'm not sure if you are aware of, since the passage of it in February of 2010, nearly 12.3 million private sector payroll jobs have been created. Something pretty good to take back to your districts. Further, our economy has added 3 million new jobs over the past 12 months, and nearly the fastest growth in more than a decade. Those are achievements of the Dodd-Frank, because I think it also created the Consumer Financial Protection Bureau. Since its inception, the Bureau has returned $5.3 billion to 15 million consumers who have been subjected to unfair and deceptive practices. So where I'm going with this, since I repeatedly hear attempts to block the appointment of having a director or to move it towards an independent funding source. So, Mr. Staley, first with you, as this committee moves forward with its oversight and financial regulatory agency in drafting financial services legislation, what do you think we can do to ensure that CFPB is able to continue its legislative mandate and be fully funded?
Frankly, I think the structure that currently exists in the Dodd-Frank Act, which provides it with dedicated funding from the Federal Reserve, as the other financial regulators receive, with the exception of the CFTC, they are self-funded and not within the appropriations process. I think maintaining that is very important. And frankly, I think that structure of a single director helps the CFPB act quickly and forcefully when it sees problems. So I think that maintaining that structure in the Dodd-Frank Act would be is very valuable.
And to the other witnesses, if there were not the Dodd-Frank Consumer Protection Bureau as it is, how would you counter these achievements and wonderful statistics that it's been provided to do?
Well, it is, of course, hard to run the experiment and go back and say what would the economy look like today without Dodd-Frank. We unfortunately lack the ability to do that. And I would just say that everyone believes that it would be wonderful if we could come up with a way to reduce the likelihood of future financial crises. And Mr. Stanley, I think, did a very good job of quantifying what it would be like if we could reduce the likelihood of future financial crises. Unfortunately, I see no evidence whatsoever that Dodd-Frank is going to do that. I think, in fact, there's a very good chance that it will make future financial crises more likely because it is concentrating risk, for example, of derivatives transactions in a new too-big-to-fail entity, a centralized counterparty. It is going to, I think, inevitably force more activities under the umbrella of the too-big-to-fail banks. And I think by doing
because
that,
my time is short, let me piggyback and ask you a question on that. I think you said in your testimony that Dodd-Frank misunderstands the causes of the financial crises and in particularly blames monetary policy, federal housing policy, and moral hazards created by government bailouts. So in your opinion, what were the main causes of the recent twin housing and financial crisis?
I think the cause of the housing and financial crises had in part to do with government policy. They had in part to do with the fact that banks that tried out new forms of mortgage loans that were not very well tested. Those turned out to not work as effectively as the banks thought they would. And in a well-functioning market, the banks that did that would have been allowed to fail. That wasn't what happened here.
The gentlelady's time has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner, for 5 minutes.
Thank you, Mr. Chairman, very much, and thank you, panelists, for being here. I'd like to discuss the Dodd-Frank Act and the regulatory overreach that has resulted from it now that we are 5 years out from the law's enactment and have seen many of the over 400 separate rulemakings required under the law go into effect, with many more in queue. We are starting to be able to more accurately see the long-term consequences from such a massive piece of legislation. Many of the consequences, I believe, are unintended. A recent research paper released last week from the American Action Fund Forum, estimates that the burden of compliance under Dodd-Frank will result in a reduction of nearly $900 billion in GDP over the next 10 years. The study goes on to say that this will in turn result in a cost of over $330 per year for each working-age person over the next decade. $330 per year per working-age person. For families, this is, for many of them, it's a car payment, it's a whole month's worth of groceries. Mr. Mahoney and Ms. Pierce, these are just some general questions, how has regulatory overreach from Dodd-Frank contributed to increased costs for working Americans?
I think that's a great question, and the focus on compliance costs is one thing to look at, but there are actually costs that are deeper than compliance costs, which Correct. Are the structural problems that the changes are creating in the economy. And so I think what we're seeing is we had the example of community banks, so we're seeing a lot of community banks close their doors, and it's in part due to Dodd-Frank, in part due to other regulations. And that means that a local community that depended on that bank for loans to their small businesses, for example, is going to be in trouble. They're going to have to go somewhere else for that funding, and it's more difficult to get outside of the community. So that's one example of how Dodd-Frank has affected the economy.
I agree with that, and I would also just point to another cost that I think really has not been quantified and would be very hard to quantify, and that is the notion that because we've now given the regulators the power to look for systemic risk, that this is a solved problem and that we've banished systemic risk from the market. We have not done that. When it comes back, it's going to come back even more vigorously, and that will impose substantial costs.
And this leads almost exactly into my next question, Mr. Mahoney, which is, despite the adverse effects of Dodd-Frank, both on costs and economic growth, has it fully protected us from future financial crises?
No, I think not at all. Again, I think it does some things that could make a crisis more probable, as I mentioned, the provisions on over-the-counter derivatives and the designation of systemically important institutions. I think that the regulators ought to focus on risks rather than institutions. And I think Ms. Pierce made the very important point that by just identifying these institutions and accepting them as too big to fail rather than trying to reduce their risk, the statute goes in the wrong direction.
Well, and speaking of new institutions, as both of you know, Dodd-Frank created a number of new institutions also within itself, such as FSOC, OFR, and the CFPB, that have very little oversight and operate with very, very limited transparency. What further unintended consequences could these new institutions pose in the future beyond what was included in Dodd-Frank?
One concern that I have, for example, with the CFPB, with the lack of accountability, is that consumers are actually losing out on opportunities. It's really important for, I think, Mr. Stanley mentioned that competition can be very helpful for consumers. It ensures that they get a better deal. And if you have an agency that's focused on putting a lot of regulations in place, it keeps new entrants out, and that limits competition and it limits options for consumers, and it can hurt the consumers who are most deeply in need of options.
All right, thank you. I believe my time is run out. I yield back, Mr. Chairman.
The gentlelady yields back. The chair now recognizes the gentleman from Washington, Mr. Heck, for 5 minutes.
Thank you, Mr. Chair. I'd like to use my time today to talk about markets. Markets are great and powerful, and I firmly believe that the strength of our markets is what led us to win World War II and the Cold War, and served as a shining example for a lot of other countries who set up their post-war economies. But just because that markets are better, and they are, than a command economy does not mean they're perfect or 100% reliable. And no reading of history could conclude thusly. Frankly, I feel like that's being lost in the service of ideology. When we were contesting a philosophical battle with the Soviet Union, we were very aware of market shortcomings. In the early days of communism spread a century ago, I remember it well, we recognized that financial markets are prone to panics, and so we set up commissions to regulate the futures market and stock markets. We recognized that money markets are the same way and that they drive boom and bust cycles in the broader economy. So we set up the Federal Reserve to smooth out the money supply and try to promote economic stability. We set up the FDIC to try to bring an end to bank runs that happen in a free market for deposits. We set up a whole host of agencies to smooth out the market for home mortgages, and the list goes on and on. It took a while for all those systems to evolve and be put in place and work, but 75 years after the Great Depression, it is fair to say, it is accurate to say, that economic growth has been steadier and more broadly shared than it was in the 75 years prior to the setting up of some of those entities to help. We recognize now that there is inherent volatility, and to, in fact, harness the power of markets and to enable growth that's shared by the masses, if you will, we need to have these entities functioning. And I miss those days. We're having a fight lately over another one of those agencies that was set up to address market failures 80 years ago. We all agree, everybody in this room, that in a perfect world, the Export-Import Bank wouldn't exist. Of course, in a perfect world, neither would the FDIC, neither would the Federal Home Loan Banks. In a perfect world with perfect markets, we wouldn't need to respond to market failures, but markets aren't perfect. In our world, we recognize that even if we could somehow get China and Russia to play by the same rules as everybody else so that we had a level playing field internationally, trade financing markets would still fail in predictable ways. International financing markets would still have panics and would still freeze from time to time. Good customers in countries with poor legal systems would still struggle to get loans to buy products. Small companies who use community banks would still not be able to get working capital for products to be sold out of country. Private credit insurance would still only be available at scales too large to be useful to small manufacturers. These are predictable market failures, and they will reappear if the Export-Import Bank goes away. Even the banks that compete and function in trade financing acknowledge it. We used to be dedicated to addressing the failures of market so that everyone could benefit from capitalism's strengths. Maybe we did this because we were committed to helping all Americans share in capitalism's success. Maybe we did this because we were worried about being embarrassed by communist propaganda. Either way, we seem to have lost our way. The Export-Import Bank is good for capitalism, but capitalism's self-appointed defenders frankly seem to have lost sight of that. And I frankly hope we can reverse that mistake before it is too late. And to put a fine point on it, too late is defined here today, now, in this moment of 23 more legislative days. I pray that does not happen. With that, Mr. Chair, I yield back the balance of my time.
The gentleman yields back. The Chair now recognizes the gentleman from Colorado, Mr. Tipton, for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank our panelists for joining us here today. Interesting hearing your comments. I come from the private sector, small businessman. And best definition of that, I guess, is you're working on the high wire without a net. There's nobody there to catch you. And that's actually the best incentive to be able to perform and to be accountable and responsible with the dollars that you currently have. And I share, I think, a great concern with many of my colleagues that with the institutionalization of Dodd-Frank that we are seeing an incredible overreach that's going to be impacting the freedom that this country has been built upon to be able to have great entrepreneurialism, to be able to create jobs. When I'm hearing comments that we are having a recovery, I'm strictly reminded that we have the lowest labor participation rate in 4 decades. We are seeing $2 trillion in costs now that are coming on to businesses nationwide. For the first time since we have kept records, we are seeing more small businesses shut down than there are new business startups in this country. And are we seeing the government becoming a platform off of which to be able to launch entrepreneurialism, to be able to put people back to work, or has it become a stumbling block? And that's my concern, and something, Mr. Mahoney, I'd like you to be able to speak to when we're looking at the FSOC. Given the broad definitions that are put forward that for the FSOC, that they can work on anything that is a threat to the financial stability of the United States. Given that definition, do you have some concerns that we could see the Federal Government moving into a variety of different areas, instruments in terms of financial liquidity that can hurt economic growth in this country, and something that's critically important in my district for young people to be able to live in that American dream?
Yes, I agree with that, and I think that the very vagueness of the concept is itself going to be a problem, because ultimately when you have something like affect the financial stability of the United States that does not have any recognized meaning, its meaning is going to be determined ultimately by lobbying, to put it bluntly, because businesses that want to see their competitors harmed are going to go to the regulators and say, you know, what that person is doing is a bad idea. What we do is the best practice, and I think it's very important to note that a lot of regulation, a lot of discretion exercised by regulators tends to be because obviously they're not involved in the markets day to day. They have to get their information from somewhere else. So they turn to so-called best practices, which typically are just what the very largest firms do because they can afford to do it. And smaller businesses can't afford to do it, and they're the ones that are harmed.
And I appreciate that comment, and I think it comes to a specific point. And Ms. Pierce, you might want to speak to this as well. We often talk about the big institutions. We need to be able to regulate them as though they're autonomous from the rest of the economy. And I'm worried about the folks back home who are trying to be able to put food on the table for their families. As we increase these regulations, and no one argues that there shouldn't be some regulations. I think many of us are just hoping we can find some sensible common sense regulations to be able to apply. Are these costs impacting the people who are ultimately paying the bills?
Yeah, absolutely. When we talk about imposing costs on financial institutions of any size, ultimately a lot of those will get passed on to the consumers and companies that rely on those financial institutions. So it's something that we really do need to be concerned about. And if we focus on, I think as Dean Mahoney laid out really nicely, one of the problems is that regulation can entrench certain regulatory schemes that work very well for certain institutions and keep out new entrants. The best way to lower prices for consumers and to increase their options is to have more competition.
More competition. Mr. Mahoney, you were pointing out and have spoken to, we're seeing more small banks being shut down. I have cited in this committee a bank in Delta, Colorado, $50 million, small bank, saying that they don't know if they want to continue because they're working not for their customers but for regulators and for the Federal Government. Is this helping the American consumer?
Not at all, and I would just note in the few seconds left that virtually all of the bank failures since 2010 have been small institutions. Only a handful of those have had assets of more than $1 billion.
Thank you. Yield back, Mr. Chairman.
The gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Please allow me to address the notion that the do-nothing solution was the best or better solution. The do-nothing solution assumes that things couldn't have gotten worse. The recession of 1929, which was the Great Depression, disproves this. Things could have been worse. How soon we forget? Bear Stearns, Lehman, AIG, banks were not lending to each other. I was here. I saw it unfold before my very eyes. Banks refused to lend to each other. How soon we forget. Rush to judgment. Somehow we went to bed one night, came to work the next day, and created Dodd-Frank. Not so. Amendments. 120 Republican amendments considered, 46 roll call votes for Republican amendments, 51 Republican amendments accepted, 134 Democratic amendments, 24 bipartisan amendments. Debate time, a total of 15 hours and 41 minutes, and this is with reference to the Financial Stability Improvement Act. There was careful, considerable deliberation before this legislation passed. Small banks. There is a deep, abiding affinity for small banks among the members of this committee. Unfortunately, when we try to do something for small banks, by the way, 90% of all banks in this country are small banks, 90% plus, and they're under $1 billion. We could pass legislation for small banks, but for the fact that when we try to do something for the small banks, it becomes legislation that will also impact $50 billion banks. Huge banks. I support doing something for small banks and will work with anyone who wants to do something for small banks. But I refuse to allow the facade of small banks to become what's called a community bank that's worth $50 to $100 billion or even more. We've had one witness who said that any bank can be a community bank. So I no longer use the term community bank because we're not talking about the mega banks. I agree with the concern for small banks. Want to do something about it. But we can't do it if we continue to allow the mega banks to drive the legislation. And that's what's happening here. The mega banks want legislation, so they use the small banks to accomplish their ends. This is the real deal. This is what's going on. How soon we forget. I think another appropriate title for the hearing would be, let's get back to business as usual. Let's get back to no Financial Stability Oversight Council. It's not perfect. What is? But it does provide us at least an opportunity to look for the next crisis. Ending too big to fail? Well, why not have a means by which you can wind down the next AIG? Doesn't mean that you won't have a bank that's so big or some institution that's so big that it can't have an impact, but it does mean that we have a way now to deal with it. We didn't have that before Dodd-Frank. Let's get back to business as usual. Stock market's at an all-time high. Big investment banks and companies are making lots of bucks. We're here trying to help them make more money when we got people working at minimum wages and can't take care of their families. When are we going to hear something about raising the minimum wage? We take care of those at the top at the expense of those at the bottom. I yield back, Mr. Chair.
The gentleman yields back. The chair now recognizes the gentleman from Arkansas, Mr. Hill, for 5 minutes.
Thank you, Mr. Chairman. Thanks for the panel for participating in this hearing. Appreciate it very much. Mr. Maloney, I'm interested in your thoughts, and the panel, please join in as well. The Financial Crisis Inquiry Commission was well conceived and well designed right after the 2008 crisis, and it put forward a very thoughtful report, and yet Dodd-Frank was passed 6 months before that report ever came out, which really struck me as a business guy, the cart before the horse. But of course, the President asked for a deficit panel to be impaneled when he first became President to try to reduce our chronic budget deficit and our chronic debt, and he ignored that report as well. So I'm interested in what your thoughts are that were contained in that commission that were ignored or not contained in Dodd-Frank that are good ideas and should have been considered. Mr. Maloney, you want to start?
Well, I think I would just start by saying the report tried to have a little something for everyone in the sense that it pointed out some of the policy issues that we've discussed today, the monetary policy questions, the government housing policy questions, but it also pointed out some of the issues that market issues that have widely been blamed for the crisis: securitization, over-the-counter derivatives, combining banking and capital markets activities into the same institution. The thing that's always puzzled me is if those things were so destabilizing, it's a little bit strange that the financial crisis didn't occur much sooner. I mean, those things were all underway in the 1980s. The financial crisis happens in 2007, 2008. Why did it take so long if those things were so incredibly destabilizing? So I find the sort of smorgasbord approach of the report a little bit puzzling.
Ms. Pierce.
I would point to Peter Wollaston's dissent, which talked about housing policy. And while I don't think housing policy was the only cause of the crisis, I do think that he does a nice job explaining the role that Fannie and Freddie played in the crisis, and that, of course, was left out of Dodd-Frank entirely.
Mr. Stanley.
I do think that many elements of the FCIC report were addressed in Dodd-Frank, and many of the people who testified before the FCIC also testified before Congress in helping to shape and frame the Dodd-Frank Act. And I also think that Dodd-Frank included many things in it that were that came directly out of the regulatory response to the crisis. For example, the regulators were already working on the new Basel capital rules, which contained many changes in the rules to respond to the problems that were seen in the crisis. And a lot of the times when people talk about Dodd-Frank, they're actually referring to those new Basel capital rules. They're referring to the continuation of the Federal Reserve stress testing started in the crisis. A lot of things in Dodd-Frank emerged directly out of what was learned in the crisis and that response.
I'd like to ask each of you, would you support a single prudential regulator that was not the Federal Reserve, that was a separate independent regulator that had bank, not talking about securities, but bank authority, and put it in the hands of one non-Fed prudential regulator? Mr. Maloney.
So I think either a single prudential regulator or simply ending the problem that we did have, and it was a regulatory problem that we should have solved before the crisis, which is that you had holding companies that had individual functional regulators at various regulated entities, but there may not have been a single regulator that had a complete picture of everything that was going on within the holding company. I think that was particularly true in the investment banks, and I think having a regulator at the holding company level that's looking at everything is a perfectly fine idea. Now, that could be the Fed for banks, the SEC for investment banks. It could be a new prudential regulator, but I do think that is a sensible reform.
I think pulling the regulatory responsibility out of the Fed is a very important step. Putting it in one prudential regulator for banks could be a good idea. Of course, the structure would matter. You would want to make sure that it was subject to appropriations and had the proper oversight, not that it had a commission structure, for example. I think that would be very important.
The gentleman's time has expired. The chair now recognizes the gentleman from Maine, Mr. Poliquin, for 5 minutes.
Thank you, Mr. Chair. Appreciate it very much, and thank you, folks, for sitting through this for a couple hours now or going on that. I appreciate it. Part of the American dream is everybody wants to own a home. That's good. However, up until roughly 2002, 2006 or 7, it seemed like there were Washington regulators who were putting lots of pressure on banks to make sure they enticed families to buy homes even though they couldn't afford those homes. Sometimes they pressured banks to offer no money down. Some folks that applied for homes didn't have jobs, but they were still given credit in order to entice them to take on more than they could chew off. And then when these folks couldn't make their mortgage payments, the housing market collapsed. And with that, it took the financial services industry, or the financial markets, that collapsed. And so here you have these families who are now going through this process of losing their homes or going through bankruptcy, and some of the reason for this happening were the bank regulators here in Washington. Now, in my district, which is western, central, northern, and down East Maine, some of the hardest working people you could possibly find, they saw the value of their homes plummet 40, 50%, subsequent to the market crash. And folks that were saving for their kids' college education or their retirement saw their savings in mutual funds and 401k plans plummet 20 or 30%. So now they're in a position where they have to work longer. Their nest egg has shrunk, and now they're more and more dependent on the government. Not to say that we have a Social Security system that is a $15 trillion unfunded defined benefit pension plan with no real plan to take care of that. So, of course, after this happened, Washington knows best. The big brother government sort of ran to everyone's rescue. Even though it helped create the problem, they imposed this huge Dodd-Frank net over the entire financial services industry. And, I come from Maine. We do a lot of fishing up there. And sometimes the net should have holes in it big enough for the small fish to get through. So we have a real problem here in our district with small banks, and as my colleague Mr. Green mentioned, he may not want to call them small banks, I call them community banks, but whatever it is, we get a lot of small credit unions and small financial institutions, small banks, that are the backbone of our economy. And they want to lend money to individuals who want to buy a new truck or maybe put a new diesel in a lobster boat. And they're unable to do it because of some of these regulations. And so what happens is the cost of regulations go up. Bank fees go up. You talk to Larry Barker, who runs the Machias Savings Bank in Down East Maine, and they have about 100, 120 employees, and they're putting more people on the payroll to deal with regulations, instead of lending money to folks who need it. So I am really concerned about this Dodd-Frank net, who will start to smother our small banks that are the backbone of our community. Jobs are being lost, credit's not being extended. And then if you go over to the investment management space, you have fees going up and rates of return on retirement savings going down. So I'd like to ask you, Ms. Pierce, first, if you don't mind, is do you think, can we agree that this is happening? There should be reforms to this regulatory burden, and specifically, what would you recommend? How can we help our small community banks keep money flowing to our families, grow businesses so they hire more people?
The Mercatus Center did a study a couple years ago on small banks and found that indeed they were suffering very heavily, and it was this concept that you mentioned of spending a lot more time on compliance, trying to hire more compliance employees, but even more important than that is the manager's time is now going towards thinking about compliance and regulation instead of consumers. So the answer, I think, lies in simplifying bank regulations. You could have a simple capital standard, for example, and then in return for that, you eliminate the other regulations that require a lot more time to think about complying with. So I think the simple regulations can benefit banks of all sizes, but I think especially small banks will benefit from that change.
So you do believe that there should be and could be reforms to Dodd-Frank?
I believe that reforms are necessary to make the economy work better.
Mr. Mahoney, what do you think?
I agree with that. I've been struck by the number of bankers that I've spoken to from banks of all sizes who now say, my primary constituent is no longer my customer, it's Washington, D.C.
I hope you folks speak up. You have a tremendous amount of authority and influence here in Washington with your experience in this area, so I hope you speak up, and I'm very grateful that you're here today. Thank you.
The gentleman.
My time has expired. Thank you. I yield back.
The gentleman yields back. I believe that concludes all of our questions for today. I want to thank the witnesses for their testimony, taking time out of your busy schedules to provide your insight on this important issue. Without objection, all members will have 5 legislative days within which to submit additional written questions to the chair, which will be forwarded to the witnesses. I ask the witnesses to please respond as promptly as possible to those questions. Without objection, this hearing is adjourned.